Everybody. I think we'll make a start. We have a few latecomers, but we've got a number of people online. So rather than let's stick to the timetable and the agenda. So hello, everyone, and thank you to those that have dialed in from Brisbane, Melbourne and Adelaide. Really appreciate it. Welcome to 2024. Sorry, that's not 2024, but tonight what we want to do is focus on some of the issues and address some of the issues that we think are going to be dominant in the banking and financial services sector in 2024 and in the future years, and that is credit and cyber risk. So before we begin, I'd like to acknowledge the traditional owners, the Gadigal people of the Eora Nation, as custodians of this land, recognising their connections to land, waters and community. I'd like to pay my respects to their elders, both past, present and emerging. And I'd also like to pay my respects to any Aboriginal and Torres Strait Islanders that are joining us this evening. So this evening's event is going to consist of two discussions on the two key themes that I think are really prevalent in the market, and that is credit and cyber risk. Tonight, we're going to be launching our latest research report entitled Emerging Opportunities, the in-depth assessment of whole loan sales in Australia. Whole loan sales is a funding technique that is used commonly in other markets offshore. We have not seen its prevalence yet in Australia. So what we did is conducted a detailed research report into the funding efficiencies of our market in Australia and the potential for a whole loan sale marketplace opportunity in Australia, examining the benefits for banks and non-banks and investors. We got the fortune of having Gary Lambert, the author of tonight's report, in the room with us tonight. Gary has done an in-depth study and a very excellent report, which we will email to you later this evening, and we'll hear from Gary. But we've also got some experts in the room that will be joining us on a panel discussion. We have Carl Sick, the Group Treasurer and Chief Operating Officer of BC Investment Group. We have Rick Lee, the Group Treasurer of RedZ Lending Solutions, and we have Theo Kaligaris as the Senior Portfolio Manager from Realm. We will hear from these gentlemen, and you will have an opportunity to ask them questions as well. The second half of tonight's proceedings will probably consist of a topic that is arguably the fastest growing concern in the banking and financial services sector. As we know it, cyber risk. Topic on everybody's tongue and at every board table. And tonight we have some experts in the room. We have partners from the Deloitte's advisory group. We have Evan Kuvani and Carolyn Sue, who will give us an insight and tell us about a report on cyber resilience in a changing landscape and the trends for 2023 and beyond. They will be joined by Jason Purvis, our Chief Information Security Officer at Perpetual, and our very own John Elder, a GM of PCT's digital innovation company called Perpetual Digital. So look forward to that. But before we begin, just a little bit of housekeeping. Bathrooms, unisex bathrooms are just outside in the lounge here. Ladies' toilets are down this passage, and men around the front back to reception. If you could please turn your mobile phones onto silent for this evening's event, that'd be much appreciated. And another small ask is we will email you a survey form at the end of the evening just to give us some feedback as to what you thought of the event, but more importantly, to hear from you about any other studies that you would like us to provide insights on. So without further ado, let me welcome the infamous Gary Lambert. Thank you.
Thank you, Rod. That came around quick, didn't it? I was just thinking as I was preparing for tonight, and the excitement I get when I've got somebody else speaking as well, because by the time they come around, you'll have forgotten what I've said. But this whole AI thing has got me beat, right? Like back in my day, AI stood for artificial insemination. What happened? It's like I fell asleep for a few years. But anyway, I'm going to talk about whole loan sales and alternative sources of funding. And anything could happen. So we'll see where we go from here. All right, and we've got some beautiful pictures, don't we? I didn't pick these, but it was a great, was part of the process to decide that it was the underwater theme that we needed to go with, because what we're going to try and do is get into the depths of what this alternative funding source might be. And the other good thing about talking about the future is that by the time the future comes around, people will have forgotten what you said. So you can say anything you like. It's great. Okay, 5 things we're going to talk about today. The first is about definition and what is this thing called a whole loan sale. We're going to talk more broadly about alternative funding sources as well. We'll have a look at what's happened so far in Australia. We'll have a look at why it's happening now. Is it a sustainable event or not? What are the practicalities involved in it in case you're thinking about dipping your toe? And what the future potential might look like. So for once, I didn't make the mistake of giving you the whole story as I went through the agenda. That takes a little while, many years to perfect that art. Anyway, this is how we did it. We talked to a lot of people, in fact, some of the people in this room, and it was all anonymous. This is what I say to people when I start out doing these interviews. It's 100% anonymous. You will not be identified. And through that, people are prepared to say some pretty wild and wonderful things, as you'll see as I go through the presentation. I did 17 in-depth interviews. And then we did a mini survey as well, because we wanted to put some numbers behind things just to get a feeling about whether what was coming out from my conversations were fairly wildly held views or widely held views. So we did a little survey. I'll give you some of the results for that. Spoke to both issuers and financiers of all kinds. We had plenty of diversity in people who responded, and it was just conversations. We just kept talking until I think we talked ourselves blue in the face. Anyway, let's get to this definition first. We're talking about whole loan sale transactions. What on earth is it? So people were telling me all sorts of different things as I was having the conversations with them. So I wrote a few down, and then we sent this survey out, and this is what people were fairly comfortable noting as whole loan sales. So it could be portfolio sales between an issuer and an investor, future flow arrangements, private placements, and sales of distressed assets. Now, talking to people who've been around for a long time, and particularly those who've come from overseas, they went to pains to sort of say, well, the whole thing started because after the GFC, there were so many distressed assets in Europe, somebody had to buy them, and the whole loan sale industry began. So that was one view that came through. But from now, people are saying, well, there isn't a fixed idea of what this thing's all about. In fact, we are just scratching the surface, and that's what makes it very, very exciting from originators and investors' point of view. So why are we wanting to talk about it now? Why are people in the market talking about it? Well, for some people, it's about it is the right time. It does seem as though we need diversity of funding. In fact, in some research I did last year, the report we did last year, everybody was talking about diversity of funding. But the funny thing was not that many people were doing anything about it. But all of a sudden, people are taking more interest. There's new investors out there. They're just lurking offshore. They're just waiting to come in for when this thing really takes off. And there's a belief that there are plenty of investors, not only offshore, but even onshore, that may well be interested in whole loan sales if it does become more commonplace. And of course, the Australian market is wonderful. We're having a little chat outside about the mortgage cliff. We're still looking for it. It hasn't happened. It doesn't look likely to happen. And why is that? Well, people like living where they live. They like their home, and they keep paying the rent, even if they're not going to eat. So that's what happens. So don't worry. In case you're worried about the market, it's pretty strong. But the funny thing is about this whole loan sale business is that not many people have actually done one, right? And when you haven't done one, the first one is always going to be a tricky thing. So I found 9 of the 16 respondents in that survey we did had not participated in one of these, and 6 of those people said, look, one of the things that might stop me from doing it is you need some expertise. You need to know what you're doing. You've got to put the training wheels on before you can dip your toe and really go for it. And of course, the other thing is the market's been pretty good for people. The RMBS markets have been good. Warehouses have been fantastic. Look at how many warehouses we've got in Australia now compared to 10 years ago. With all that available, all that funding available, there hasn't really been a need to look at alternatives, even though people are really focused on the importance of doing so. Now, there's a bucket load of benefits in doing these things, and I'm not trying to sell them to you, but like when I ask people what are the benefits of whole loan sales, they just rolled off the tongue. And one of the ones I found really interesting was the opportunity to put in assets that you might not get on your into an RMBS deal because it didn't fit the profile of your warehouse, or they were just a little bit unusual. Good, solid, quality assets, yet not fitting anywhere else. So an opportunity to sort of put those into some kind of package. The flexibility it gives you was a common thing people were talking about. It does give you that diversity, and it's capital efficient. So there's lots and lots of good reasons. And I love this particular quote because talking about colourful language, how many people can get both fickle and violent gyrations into the one sentence? It's fantastic. I keep looking at that one. It's going to be on every page. Okay. Well, the other thing that makes it really interesting, though, is it's all very well for originators to wander around saying, hey, this is the next big thing, but you've got to have investors as well. And when I asked investors what the benefits were, they had a bucket load of benefits in their mind as well. They were quite different, of course, because it was from their perspective, but there were plenty of good reasons why people might be interested in whole loan sales. They go into those RMBS deals and they get bumped. They can't get as much as they like. This gives them the opportunity to get the kind of volume they want in the part of the capital stack they're actually looking for. You can get assets right across the stack, which is useful to plenty of investors. And also the fact that you're actually dealing with one counterparty. And if you've built a really good relationship with that counterparty, you can do pretty amazing things because everybody in this industry absolutely loves relationships. It's a relationship-based industry. I remarked several years ago when I went to my first ASF conference, and it was lunchtime. And the only thing you couldn't see at that conference was a mobile phone. Not a soul. That's a relationship-based industry, and it is pretty darn rare because I go to a lot of conferences for a lot of things, but I'd never seen that before. Now, it was 1986. I don't know if they'd been invented. Anyway, there are new investors on the horizon, and this is what makes it really exciting for originators in Australia because just the prospect of having diversity of investors is equally good as having diversity of funding sources. So tons of people like it because they like the residuals. There are MES funds or even credit funds or PE firms. These are all the sorts of people investing in them overseas, and these are the ones that are lurking offshore. They might knock on your door any day of the week. You need to find someone who's got a meaningful amount of money and be willing to take the risk on individual mortgages, but they are out there. And even people were talking about the big Australian super funds. Would they be interested? Would they get involved? And there's every good reason that they may do that. So what's holding it back? There's a lot of talk about it. People are interested. There's a few deals going on, but there's not a lot. It's not a huge flood just yet. So what is it? Well, the old complacency, there's enough easy funding out there through the warehouses and through RMBS. So I'll just stick with the knitting and stick what I know best. The first one, it could be hard, like there could be stuff that you need to do and think about that, might just make it not worth the effort the first time round. But of course, after that, it becomes a bit easier. Is there going to be an ongoing, is it sustainable? If I do one today, am I going to be able to do one next year or the year after or next week? That sort of thing. And some people are concerned about the optics. Because if you're selling off the loans, what does it do to your balance sheet? And what does it do to the shareholders and people looking at how your business is growing? There are a few people that brought that one up. And of course, the value. It's all very well to say this is a great idea, but is there value in it? And how do you line that value up with other things that you might do or the things that you might do ordinarily? So there are some practicalities. The first one's hard, but of course, then it gets easy. And this is from people that have tried and given it a go. There's an opportunity here to start supercharging reporting. Now, I know this industry loves working with Excel, and Excel will never die, but neither will cash money, and yet everybody's tapping. So things can change. AI has changed. Everything is changing. And the fact of the matter is having supercharged reporting that make it easy at the press of a button to do the things you want to do is a really attractive prospect. Service is really important to originators, though. And there are plenty of originators that say, look, if there's any damage to my client or customer relationships, I don't want to know about it. So people are passionate about, particularly originators, passionate about their customers and don't want anything to interfere with the relationship they have with customers. So it's going to be pretty rare to be selling off both the servicing and the whole loan sale. And of course, dealing with rate rises is a good example. What happens if you've sold the whole thing? What does the new buyer do when there's a rate rise? How do they manage that if you're still servicing the loan? So all of those issues are in people's minds and can have an impact on whether they're going to get interested. Pricing and timing, of course, is another one. And of course, going through the cycle, if you have a look at the bottom there, how well does whole loan sales work through the economic cycle? Well, there's a lot of people sitting on the fence there saying sometimes works well and sometimes not. So there's hesitation, and there are people thinking, well, maybe it's a good thing, maybe it's not a good thing. Is it going to work? I don't know. Am I thinking about it long term? Am I thinking about it short term? And some of our panel members might talk through some of those issues. And when it comes to a benchmark, well, there's variety there as well. This is why you talk to a range of people, you get lots of different answers. It can be good when everybody gives you the same answer, but it gets a bit boring. We like different answers. Here's the diversity. Okay, what about if you are able to standardize and make it simple, make the whole thing simple, would you be more attracted to this idea? And maybe this highlights an underlying fear that people have. If there's no consistency, if there aren't any standards, it's just too hard to work out, and I'll just do something that I already know. But plenty of people said, well, look, bring it on. You give me that standardization and I'll be there with boots and all. So finally, one of the things I did, which was interesting, was at the end of each interview I did, was I asked people to give me a gut feel of what the prospects were for whole loan sales in Australia. And I listed them all out at the end, and there were a lot of comments about, yeah, it'll grow, but it'll be slow. So it'll grow, but it'll be slow. There's a slogan, I just made that one up. So just remember that in 5 years' time, when you're thinking back to this presentation, have I predicted the future? But that's what people think. It's not going to be a flood, it'll be a trickle, but it'll keep flowing, and it makes for a very interesting time in the next 4 or 5 years. Thanks very much. Thanks for listening. I'm going to invite my panel up now to have a bit of a chat about some of these issues. Introduce at the beginning. That'll be fine. That should have gone green on my face. Your lights flashing, or are they
Green.
they stay at grey? Yeah, okay.
Mine's ticking.
I got 1 foot in each grave, I think. Okay, I think I'm all right now. Very good. I don't need that anymore either, do I? Terrific. Well, we're going to have a good discussion here today. Now, my instructions for these panel members was we need controversy. If there's no controversy, Graham Metcalf is going to go to sleep. So if that happens, it is not going to work, right? We're going to start with Rick because Rick's right in the thick of things when it comes to this concept of whole loan sales. And look, one of those last things that we saw there, you know, people are wondering about whether this is the right time. Are we in the right part of the economic cycle to be looking at things like alternative sources of funding per se and whole loan sales in particular?
I think so. I think I agree with the comments that you've made in the presentation there. One of the drivers for whole loans is really around the opportunity for investors to pick up some yield. As you know, cost of funds is quite high at the moment, and certainly I think investors are seeking some benefit in terms of deriving a good return for the risks that they're taking. There are a broad spectrum of investors in relation to where they might pick in terms of the capital stack. But for us, I think diversity of funding is really around where the funds are coming from, and as well as what we can do to improve our service to the borrowers. So in another word, I think the diversity of credit risk associated with the sources of funding is an important part of it.
So does it need to be whole loan sales though? I mean, what are the best forms of alternative funding to RMBS and warehouse?
So away from traditional RMBS and warehousing, we've seen an increased amount of inquiry or interest in relation to private placements or very bespoke type securitizations as well as whole loans. Now, when it comes to private placements, it can be anywhere in the stack. It could be the whole stack, and it really is around the bilateral agreement between the originator and the investor and the particular outcomes that they're looking for. For instance, you might have an insurance or a life company that has long dated liabilities and looking for assets to match those liabilities there. Or you might have PE firms that are looking for assets that are esoteric or even distressed that pays and suit their thresholds.
No, that's interesting. Esoteric, that's a big word, isn't it? I always struggle with that one. That's a bit highbrow for me, Rick, but thanks for that. It's wonderful. Now, Theo, okay, so it's all very well for originators to say it's a good time to be looking at diversity of funding, but do investors care at the moment? Is it a good time for investors to be looking at things other than RMBS and so on?
It's actually really interesting. RMBS was always considered the alternative. Even now, when you're pitching to people or you're pitching to family offices and others, you always get classed in an alternatives bucket the second that you talk about RMBS. I mean, for the last 5 or 6 years, every time I mention securitization, people's eyes glaze over for the most part. So you really got to go through the education piece and teach them what RMBS is, let alone going through what a whole of loan funding sale is and how you're going to get the capital together for something along those lines. From an investor standpoint, it's really interesting because when you actually do look at the issuers, we love seeing whole of loan sales. It shows the ability to de-risk the balance sheet more than anything else. Shows that you can use different avenues. You're not just using your warehousing, your public asset side. You're also able to go out to market and create this real saleable type of asset that more people will buy. But yeah, from an investment standpoint, you're going to find typically different borrowers or buyers from us as investment managers. Us as investment managers in credit funds, we're going to use public RMBS and basically warehousing so we can pick and choose exactly what our risk appetite and return targets are going to be. And that's one of the reasons public and warehouse markets have been so popular for us and why they still maintain that. So a bit controversial in that we don't love whole of loan sales, but at the same time, we love the idea in public RMBS that I can pick exactly where I want to sit in a capital structure.
So you love the dexterity of it.
I love the dexterity. It's a good word.
Yeah, it's
good. It's esoteric, yeah.
We're going to put all of these into a sentence by the time we finish. Now, Carl can be a bit controversial, right? So I thought I'll chuck him a question about the pitfalls. Well, how about the pitfalls with these sort of things? Are there barriers or limitations for doing it?
I was told to behave ahead of this session. Look, it's an interesting one. I've been involved more in the buy or bid side of whole loans. So I like buying assets personally at the right price, but never on the sell side. Probably been involved in bidding on probably 10 to 12 billion of assets and successful on probably 3 yards. And having said that, so there's a fair bit of due diligence that goes into understanding what you're actually buying and the risk reward regime. If you put whole loan sales on the sell side to create liquidity as an alternative funding source, what you're effectively coming up against relative to other jurisdictions is a fairly efficient funding market in terms of whether it's public, private, or public, private, or even what you're seeing now is more prevalence around asset management, large credit funds funding, a mix of credit. So they're your 3 primary sources which you're competing against. And then when you overlay, I guess, you've got AOFM support. You've seen recently with banks and mezzanine financiers willing to step up in times of, I guess, reduce liquidity in the market to provide that funding runway. So that's what you're competing against. And then when you overlay, when you're sort of talking about a whole loan sale, you've got a number of different subtleties. You're effectively trading away some or all of the economic embedded value in that asset. And then it's like, in terms of price discovery, everyone's got a different risk premium attached to sort of what that embedded value is. How do you land at that so that someone effectively is like, if I originate an asset, I don't want to trade it through at 98. It's going to be 10 something. And what is that 10 something? People can understand credit risk and things like that and get around losses. But one of the big ones is obviously CPR. If I buy something, assuming it's 20 and it runs at 45, someone's going to be very unhappy on that trade. That's not to say that the possibility for whole loan sale doesn't exist, but it does have some real pain points or just friction within the system by virtue of the fact that public-private issuance, it works quite well compared to you look at the UK where there's a reasonably well functioning sort of forward flow system, mini bulk, where people will trade through. But when you look at the UK market, you don't see the same volume of issuance as you do in the Aussie market. Largely fixed rate market. You see deals where the sub IG and even triple B is trading at 92, 93 to make it work from a ratings perspective. So that market there, you go a little bit more disjointed. You don't see the same natural liquidity in that sector, which means that the non-banks that are there, it becomes a hybrid where they'll issue when they can and write onto their balance sheet and then trade it through to one of the big banks on a forward flow agreement. And it becomes a combination of capital light, retained servicing type strategy.
Yeah, everything's hybrid these days.
I'll shut up now.
And pre-COVID, nobody knew what hybrid meant, did they? Well, they thought it was a car, maybe, but it's now become a very popular word. So yeah, can we come back to you about investors? So I was talking about investors lurking offshore, right? And in your mind, who really are these investors that might be interested in this market? So don't think about yourself for a minute, but just think about out there in the market. Where are they going to come from? How are we going to find them? How do we know who to look for?
Yeah, hard not to think about myself, but we'll try. So we kind of class them in three different forms. So I think that the first is obviously going to be your insurance premium guys, you guys that like the longer tail of the assets. Primarily, they're going to be your first class. Your second is anyone that's kind of an issuer that wants to kickstart one of their lending programs or wants to try something a little bit different in one of their lending programs, and they'll use a whole of loan sale agreement to try and figure out how they'd write that new cohort of loans. The third is for anyone that doesn't really have a distribution setup, that aren't really good at originating those kinds of loan agreements. So you kind of class yourself in one of those three different actions there. But especially on that third, if you find it really difficult to originate these loans efficiently, it's costing you a lot in terms of brokerage or what you're paying away, maybe a whole of loan sale is probably what you're going to be looking for in that particular instance as well.
And coming back to you, Rick, what about the practicalities? What conditions need to be in place to make it work for an originator?
I think in this environment here, I think investors tend to have a certain threshold, certain appetite in terms of regular issuances. So for an originator, I think they need to have that relationship, as you say, with the investor, firstly, and secondly, they need to be able to generate the volume to warrant some of these regular flows that Carl's talking.
And coming back to you, Carl, the notion that it doesn't work through all parts of the economic cycle, why is that?
Look, I think it's largely around the risk premium. Like when markets are fair weather and perfect, the natural go-to is through public RMBS. And you go, that's fine. In times of stress, when liquidity seems to disappear quite quickly, and then you're looking at alternative sources, to sort of approach it as an afterthought when the risk premium is far greater when you've got times of market distress or illiquidity, it sort of breaks, the math sort of breaks, unless that issuer or originator is under severe stress. They don't want to sell the assets through at par, or they might be able to get them a small premium to recover their upfront acquisition costs in terms of internal credit and whatever upfront comms they've paid. So it is a hard one that, and again, it's landing that at that aspect of what is fair value for those assets. Because again, when it's whole loan sale, it's not like a bond where it's tranched, there's a coupon and there's some money left at the bottom in theory, or there should be. What you're effectively valuing is what is left. And in times of sort of heightened stress, that number shrinks quite markedly. So it's like people might go, well, I'm better off just, particularly if they're not in a liquidity squeeze and they're adequately funded, then they're better off just sitting on the assets and waiting for the market to normalise. And you've seen that support for non-banks, and which is why, if you look at just the Australian backdrop and go and pick on the UK, there's quite a large number of large, well-capitalised non-banks in the Australian market. And you sort of see, well, that's not to say whole loan sale does not have a place, but there's just that natural friction there. And in times of stress, that is probably not your go-to. And if you were to do it in times of stress, you'd want to have engaged that counterparty well in advance. It's not something you wake up and go, I want to sell some loans tomorrow. It's not, that's the beauty of sort of primary issuance, where investors, they become familiar with your program, they become familiar with the collateral, they become familiar with the performance. So the structure might change in ebb and flow subject to investor demand and some of the subtleties of the investor appetite at the time. But it's a rinse repeat type strategy with whole loan sale. you don't sort of wake up and go, oh, tomorrow I'm going to trade some assets through because I'm in a bit of a pickle.
So you're saying it's a strategic move as opposed to a
It
tactical?
needs to be strategic, like it really does. And you'd need to engage an account. Well, I think for best outcome, you'd need to engage an account or multiples, wherever it is, well in advance to agree, I guess, what the economics look like, what the portfolio mix looks like. You can also overlay a tactical part. We go, I might want to elect to run long on a certain collateral type with a view that I'm not going to spin off into my public program, and I'm going to sell these whole loan at some type of value and agree that within some type of broad parameters, and then originate to that strategy. But realistic, like with anything, particularly when you're funding, it does require a bit of forward planning.
Yeah. And Theo, a lot of comments about pricing and value and that being a little bit difficult. What are the issues around pricing with these sort of loans?
Well, ultimately, it comes back to our investor base. So what our clients pay us to do, which is deliver a return. And if we can't meet that return, then we cease to be in business. At the end of the day, there's probably no point us even existing. So to the extent that we can't utilize these to get some level of relative value or even explain what we're doing to clients and start to manage that accrual coming through the book, there's probably no point us even looking at participating.
And is there a particular difficulty in assessing the value and potential value in these sort of loans?
I'd say so, absolutely, because you are looking at the tail of the assets as well. You're looking at quite a large portfolio. I mean, generally from an investment standpoint, in the form that they are at the moment, I wouldn't see too many of these particular portfolios come through. I'd sign the utilisation notice on the warehouses that they're getting drawn into, or the redemption notices of the warehouses that they're getting sold out at. So that's probably as much to do with pricing as I get to see. But absolutely, it is difficult to look at a lot of these assets.
So I'm just going to do a quick run through the panel before we move to perhaps questions from the floor or the cyber universe up there. The people in Brisbane I was talking about. So gut feel, just a few words. What do you think about the prospects for the whole loan sale market in Australia? Rick, what do you reckon?
I think it'll be slow growth. I mean, definitely there'll be trades in the marketplace, and we'll see more of them, particularly when offshore skilled investors are coming into the market and looking at the assets and the stability of our jurisdiction. But is it going to take off in a very big way? I would say that it probably is slow growth.
Slow growth. What do you think, Theo?
Yeah, would agree with Rick there. You'd say it is a much slower growth. You'd say that there are people out there, especially global investors, that would look to come into the space. But again, it's not something that's likely to move very quickly. It's probably a slow growth.
Okay, Carl?
I hate to agree, but I have to agree.
Oh, no, come on.
I'd like to be
like.
sensational, but no, look, I think there's certainly a place for it, but there seems to be a lot more natural sort of resistance, not by virtue of individuals or originators, but just the market backdrop. That's the reality. So UK, you look at that and you speak to all the banks, and they've all got a lot of the non-banks have got forward flow arrangements, and for a very good reason. When you see how that market moves or the liquidity disappears and the way their products are set, there's a core need for that type of arrangement. And it's not to say it shouldn't exist in Australia either, but it's just, very slow growth, I'd say.
Yeah, that's the shortest answer we've ever got from.
Sorry.
I was impressed, mate. That's terrific. Okay, have we got some questions from the floor or from interstate or anywhere out there? And we've got a microphone that we could, because people interstate won't hear if you don't give them a mic.
Raise your hands.
Always wear flat shoes if you're carrying the mic.
Hi there. It sounds like you can hear me okay. Look, I just have a question. If it's too technical, tell me. I think this is probably best addressed toward
As
either.
long as you don't ask me.
I'll target Carl and Rick here. Let's assume I'm a buyer of whole loans. And if we think about the pricing, i.e. the borrower rate, pretty simple in the context of RBA cash, right? The RBA cash rate goes up, you pass it on, and vice versa. But when we think about the margin to the borrower, clearly if RMBS spreads go wider, I'm going to want to see some of that, or potentially all of that, passed on to the borrowers. So my question is, if I'm a buyer and you guys are a seller, you're retaining the servicing, you're retaining the ability to reprice the underlying loans to the borrower, should I trust you, or should I just come up with some formula that somehow complicatedly links to
Don't
various
trust Rick.
market markets. Because I'll just overlay that with one comment. As a buyer, and JP Morgan, I'm from JP Morgan, clearly, we're looking at whole loan, purchases and being a buyer. I think I'm going to find it pretty hard to trust the originator in this respect, which is why I'm sort of asking the question.
Oh, you want to go first? I'll go first. Yeah. Steve, I think Gary touched on this quite extensively, which is around the relationship. I think for us to do business with you on a whole loan basis, you've got to have to somehow trust that we can actually originate and look after the relationship with the borrower. So when RBA passes rates onto us, we may or may not pass on that the whole extent of that rate back to the borrower, and because of cost of funds issues, because of relationship, we might see discharges pick up, etc. So what a sensible way of doing it is probably to set some boundaries that we can work within. That I won't get caught up by your decision making on this pool of loans, and we have some agreement as to what within a parameter that we could actually operate in.
Yeah, I'm inclined to agree. Look, it's a good question because, if I think about BC's distribution network and how our products are branded and things like that, it's important to set those boundaries because one, you're expected to make a return, and that can, it's all in the math, I guess. But if you were to deal with an irrational actor that decides, I want to squeeze an extra 300 out of this, and we've got origination sources that are continuing to write into our business, and all of a sudden a subset of their business, the borrowers are just torched. Like the originations would just stop with us as well. Like they'll just go to zero, and then our whole thesis for servicing a customer segment and that whole focus on trying to make some money, it is one of those ones that would certainly need to be agreed up front and having some parameters around it.
Just a related question, do you have the ability to change the rates to, say, my portfolio versus your portfolio if it's the same loan product?
Yeah, look, we generally don't. We price, like our approach is to price for risk, and we'll look at segments. We go, okay, well, there's sometimes we'll have launched a product and it's underpriced, and I might get 5 points more, but we generally try and keep it's product related, not necessarily where it's funded, so to speak. Like that's for us, the borrower shouldn't be at the mercy of how BC funds efficiently or inefficiently that loan. So we'll keep a consistent approach, because that's important even in terms of our distribution channels. You can't be seen going, oh, distribution channel X is getting 20 points tighter than someone else. It's the moral hazard when you start running down that sort of laneway.
Got it. Thank you.
Great questions. Terrific. Got some more out there or out there? Where are you? What about you, Eddie? You got one? Eddie's probably at his computer doing something else. Well, you know what it's like when you're working from home and you can't see the person, they could be doing anything. All good? Okay, well, if we don't have any more questions, must have done a bloody good job. Answered them all.
Everyone's bored.
No, he's still awake. It's all right, I've had my eye on him. All right, thank you very, very much for listening. I'm going to hand over to the cyber people, Deloitte. Thank you.
Cheers. Good evening, everyone. I'm John Alder, GM of Perpetual Digital. So I'm really pleased to be able to host the next section of the evening, which is on cyber security. I think, over the last few years, we've seen unprecedented number of actual attacks and compromises that have happened across the financial services industry. And the bad guys are getting more sophisticated and relentless in the approach. The end game is around extortion, right? It's how do they get money out of financial services industries and other industries, right? So the answer is going to be to focus as a industry with policymakers, and cyber professionals, right, to focus on addressing the issues. So tonight we're going to take you through some of the trends. The Deloitte team will take you through some of the trends. We'll unpack some of the specific approaches that threat actors are taking. And then we'll take a little bit of a gaze forward too around, well, what's next? You know, what's generative AI? What's the next kind of approaches that we see in the cyber industry? So I'll hand over to Evan, and then we'll get the panel up post that.
Thanks, John. Okay. So my name's Evan Carvimi. I'm a partner at Deloitte, and I'm one of the defenders that has to deal with these attacks on a day-to-day basis. And I've had the opportunity to work on some of the biggest breaches in Australia over the past 12 months. I've personally worked on Optus and Medibank and a bunch of others. So we're not going to talk about the specifics of any of those breaches today, but we're just going to talk about some of the trends. And, you know, if I look at this room, you know, I would guess that at least half of the people in this room will have been affected by one of these breaches. And I can tell you, when you're in the boardroom dealing with the impacted organization, it is not a fun place to be. It's really, really stressful. So I want to help you guys learn from our experience and just be a little bit prepared for if it comes, you know, your day that you had to deal with one of this as one of these events as part of the executive team or the board. You know what's ahead of you, kind of feels a bit more familiar. So, you know, as John said, the scale has just jumped a whole new level in Australia for the last 12 months. These breaches have impacted, you know, over 10 million people in Australia, which of course is a huge percentage of the population. Optus, Medibank and Latitude had the biggest impact, 14 million for Latitude. We're talking about records exposed, and this is, you know, impacting everyone. And it's got really personal on the Medibank one with the terrible things like, you know, records around who's had abortions and things of that nature being exposed. So really terrible stuff. The other trend that we've seen this year is third-party risk. So, you know, if we look at the HWL, Ebsworth, legal firms breach, they're entrusted by their clients to store the most sensitive types of documents about, you know, legal matters. And a lot of that information was exposed. Well, a lot of our clients come to us and ask for help dealing with these. And it's really challenging for you when you're choosing a service provider, a law firm, an IT company who's supporting you. You know, how do I get assurance that that partner is not going to expose my sensitive data? And what data am I actually sharing with them? You know, how do I weigh all of that up? There's been a couple of instances where file transfer utilities, things like Go Anywhere and Move It, these are software vendors that make file transfer products. So these are designed to be sitting on the internet, and you know, these are designed to be secure, but unfortunately, you know, they've had vulnerabilities, and attackers have been able to en masse hit everyone that had a Move It device and steal all of those files, and then, you know, ransom it back to them. So if we look at the industries that are impacted, you see financial services there is in the top few, along with healthcare. And one of the top threats, the top threat for the last 12 months, according to the breach data from the Office of the Information Commissioner, is ransomware. Ransomware has by far the biggest impact, and we've dealt with a lot of those ones recently. The average cost of a ransomware attack is around 5 million US, and that's increased from the previous year. So the impact of these things is huge, and that's just the kind of financial impact. There's also the reputational side to think about. Now, those things are on the negative side, and I want to draw a positive in this next statistic, the 18 days dwell time. So dwell time is the time from when the attacker gets into your environment to when you find out about it. And that could be because they pull the trigger on ransomware and your screen goes black and it says, pay me money, otherwise you don't get your data back, or because your defenders, your blue team, finds the attacker and shuts it down. Now, I actually see this 18 days as a window of opportunity rather than the attacker lens on it. This means that from the time that the attacker first gets in, you've actually got quite a bit of time to find this suspicious activity happening and contain it and stop it. So in the cyber world, we encourage you to lock all the doors and the windows. If you imagine your institution as a house, you've got firewalls, you've got web servers, you've got all these things that have software vulnerabilities. You want to lock all the doors and the windows, make sure your house is secure. Don't leave the window open, otherwise the attacker comes straight in, right? But once you've done that, there's still new vulnerabilities that exist, that come up that you can't actually predict or deal with. So you actually need a monitoring system inside the house so that when the attacker does get in, that you can see that suspicious activity. You can see, okay, the attackers got in, they were maybe hammering the front door, trying all the different combinations to get in. They found a way in, and then I saw them moving sideways in my organization, pretending to be an admin and looking for the suspicious activity. And as I manage a team of people that look at these alerts all day, all through the day and the night, and we're pretty good at picking up these attacks. So the good news is, if you have a good monitoring system in place, it's not all doom and gloom. You have this window of time to identify the threat as it's occurring and stop it. So that's the more positive side. Right, okay. I just want to touch on a few of the lessons learned from our investigations. So the first one is about your attack surface. So when everything was inside your corporate perimeter, your data center, things were a lot more simple. We're now all using cloud services. So in speaking to some of the banks, they might have over 1,000 APIs or application program interfaces exposed to the internet. These are all ways attackers can get in. So it's hard work to scan your environment, but you need to be doing it. You need to know what are the ways into my organization and what data resides behind these APIs. So a lot of companies after the Optus breach have been scanning their perimeter and trying to assess what is their risk. We spoke about third parties, and it's important to evaluate how much do I really need to share with my third party, and can I apply some masking on that data? Rather than giving them everything all about my customer base, can I just give them, a masked customer identifier, for example? That'll mitigate the risk that if they mess up, then, well, okay, no one knows which customer's data that is. Next one is multi-factor authentication. So you just have to assume these days that username and password, the attacker will have a way to find it, either by phishing, sending an email to you, pretending to be someone and eliciting that username and password out of you, or they'll just pick up some breached username and passwords from previous hacks, because these things are sold between the attackers on the dark web. So you need to have multi-factor authentication in place. The next one is, in the world of security, we're constantly deploying controls, things that make it harder for the attacker, but quite often these controls aren't deployed in full. They're not deployed across your whole environment. So it's important to be aware of what the residual risk is, to make conscious decisions on, if I'm going to say, well, okay, it might cost $1 million to put this control privileged access management across my network. I might choose to only spend half of that and deploy it to half of the network. Okay, so the board needs to understand what is that decision that we're making around, we'll put a limit on what we're spending, what we're defending, and making conscious decisions. The last thing you want is you have a breach, and then the board and the executive team are pointing at each other. The board says, well, they told me this control was there, but it was only half deployed. You don't want to be in that situation. It's really kind of ugly place to be. So try and avoid that. And then test. So you can prepare for these incidents, test your incident response plans, test your backups, and you've got to test the particular scenario where the attacker will destroy your backup management server before they pull the trigger on ransomware. So you got to go and check that, can I recover if my backup management servers were destroyed before they turned on the ransomware. So that's an important one to ask your IT teams. And then, recovery takes a long time, longer than expected, a lot of the time longer than your BCP plans, your business continuity plans. I've seen one of the ransomware incidents I dealt with recently went for 5 weeks. So that meant 5 weeks of core business was down for 5 weeks right over Christmas. So that was a tough one. So you got to be able to plan around that. How are we going to be able to operate? What's the minimum viable way we can operate if our systems are down? And then fatigue. So during an incident, in that first 48 hours, it's quite common for teams to work all through the day and the night. People get fatigued. You need to have your stunt doubles lined up. For this management person who's going to be making decisions, what happens when that person's sleeping? Who's the backup person? So just trying to prepare for those incidents. So that was all I wanted to share in terms of the lessons learned. And now we're going to move to a panel section where John's going to host.
Alrighty, so thank you for that, Evan. So I just wanted to introduce our panel before we get going. So obviously you met Evan. We've got Carolyn from Deloitte as well, a partner in the cyber team, and lucky enough to have Jason here. So Jason's the Perpetual Chief Information Security Officer, or CISO as it's known. So look, welcome to the panel. Great presentation. We'll try and keep the discussion as non-technical as possible, but happy to take questions from the audience as we go through on any avenue. First, I wanted to kind of lift the conversation from Jason, from Evan here, around the board topic, and I think the timeline of large events. And then what's not shown there is the small events that are happening all of the time. So, the regularity is increasing. The response from the regulators, APRA and ASIC, is taking a much tougher stance on boards, on directors. What kind of advice do you see from an advisory perspective for boards and directors in the kind of go forward world we live in?
Yeah, the number one thing I'd say is for boards, you need to be curious. You need to lean in. Sometimes this topic can feel a bit intimidating for non-technical folks, but I'm noticing that the boards that I speak to, usually at least one member on any board that I speak to has lived through one of these. So the level of understanding and lived experience is improving. But, don't be scared to ask questions. It does seem intimidating at first, but as a board member, board members are getting a lot of pressure from ASIC and from APRA in the case of financial services. APRA in particular has been fairly unkind, I'll say. If you say my third party was the one that was breached, it was them that lost their data, my data. APRA has been fairly uncompromising in saying, well, you choose your third parties, you live with that choice, you got to manage that risk. So it's important to understand your risk appetite and understand that residual risk. Like, what level of controls have we deployed? So the board should be asking people like Jason, putting poor Jason on the spot and asking what is the level of exposure and what is the level of residual risk, and is that within our tolerance? And then trying to have that discussion at a risk level as opposed to the technical level. That makes it a more approachable topic.
Well, that's good. Jason, look, same question for yourself there, and obviously coming from a different perspective, reporting into to those streams.
I would say I love it when boards ask me. 10 years ago, people in my job kind of sat in the back row going, pick me, pick me, pick me. I want to talk to you. I want to talk to you. I want to talk to you. We've got this really big problem. No one seems to get it. And boards, I think, largely because it didn't have the exposure that it has nowadays. And because I think at that time, certainly there wasn't much knowledge, technical knowledge, or really understanding about cyber. weren't that interested. So if I went to a conference 10 years ago, it was all about how to get in front of your board, utilize your risk committee, or all those sorts of things. That's a very different story nowadays, especially in the financial services sector. Every board and their dog is trying to get me in to have a chat about this topic. And the regulators are forcing that to a degree, but there's also genuine fear, especially after the incidents that Evan put up before. So that's good. The next big step or change I've seen with boards is in the old days, if you put up a metric that had a bunch of red on it, there'd be panic and all sorts of ructions would ensue, and your manager would sit you down and say, look, you can't put a red metric up to a board. And so things kind of got hidden and suppressed, and that's different now. Board members are now saying, where's the red? Show me the red. They've gone to cyber school. They've been told that there's certain questions they should be asking, and that if they're not being told that there is really significant risk in any organisation because of the existential nature of the threat, then they're not being told what they should be told. So it's a really positive thing. I think what's still lacking across the board, certainly in Australia, and I know regulators are starting to look at this, is it would be really useful across the board when I talk to my colleagues to have board members who really understand the technicalities of this, not the super technical technicalities of it, but a real understanding of what the controls are at a high level and what that means to a business if those controls fail. I can and spend a lot of time trying to educate boards to make that linkage between here's a bunch of control metrics that I give you, with some are amber and some are red and some are green. How does that actually translate to what the business wants to achieve? And to someone like me, it's really obvious, but what's also become more obvious is it's not that obvious to others. So part of the art is to be able to make that linkage.
Thank you. Look, I wanted to turn the conversation, Carolyn, to third-party risk, and we talked a little bit, Evan, you talked about third-party risk from a couple of different angles, and like in financial services, the cold hard reality, we're using SaaS products, we're using third-party administrators and service providers and the like, and the reality is we're sharing data. How do you see that, in the new world, how some of the strategies that we should employ when kind of choosing and leveraging third parties?
Yeah, thanks, John. This is actually my favorite topic at the moment. So, because we essentially, we're in an ecosystem. For every business to operate successfully, we need to work with our third parties because we leverage their services. So essentially, in a lot of situation, our network, we connect with the suppliers network. And also we share data with our third parties. So essentially, from a cyber attacks perspective, the attack surface has broadened. So that means, put myself, assume if I'm an attacker, if I want to get into a bank's network, it's very hard for me to get in the bank's network. I could start from a bank supplies network. From there, then I can navigate into bank's network. So talking about the strategies, John, I think first we need to have visibility. So if we don't know what we share with our third parties and exactly how they build their service upon which type of technology, so this is very tricky. Visibility is the key. Second thing is, I think you need to bring the rest of the business together with you, because every organization, you're not just dealing with one supply, you're dealing with many supplies, many third parties. So I think as a person drive the third party cyber risk, you essentially need to work with the whole business, because for a third-party cyber risk management framework to work effectively, this needs to basically implement across board. I think the last one I want to mention is many organizations doing very well when they onboard a new third party. They have a stringent due diligence checklist. However, once you onboard them, particularly for this multi-year services, then I think the regular monitoring and maintenance starts hiding behind the scene now. That is where the issues start to appear, because technology has vulnerabilities and technology ages. when it is technology is getting older, that means you are going to expose to more issues. So I think it's very important to have the visibility about who are your suppliers, third parties, and also work together with them. And when there is issue, you know who to call. Yeah, thank you.
Very good, very good. Look, I think, you know, having trusted partners in the new world, right, that are investing in security and technology will be a key part of the selection process. And suddenly cost becomes quite a different thought, right? When you look at your number before, right, $5 million US per breach, right? So the cost of that outweighs sometimes the pricing through RFPs and so on. Wanted to take the discussion, Evan, to yourself around the impact. So that same point, $5 billion US per breach, you know, huge amount of cost and a long tail, right? That cost is goes over multi years. It's reputational, it's brand, it's increased, you know, costs to customers and so on. Prevention's key, but what can organisations do to reduce the impact and the consequence once something occurs?
Two things. Firstly, going back to that 18 days we spoke about earlier, that window of opportunity to catch the attacker and shut it down before they've found your sensitive data and exfiltrate it. So it's important to do, you know, your cyber hygiene, you know, to lock the windows and the doors, put those firewalls in place, put the controls in place, but you have to assume a determined attacker will find a way in if they've got enough time and energy, and you know, if the asset that they're after is high enough value. So that monitoring system is actually quite successful. You know, we can usually detect the threat actor's activity once they get in within the first, if you can detect it in the first hour, the first day, even the first week. It's very hard for an attacker. If you've got tripwires everywhere, you know, this looks suspicious, then it's hard for the attacker to achieve their objective. So you can shut it down early and avoid that impact event. And we do this every day of the week for our clients.
Okay, that's good. Jason, I was keen to kind of get us to cast our eye forward, you know, what around emerging threats. What do you see the kind of next phase? What are the predictions around the changing landscape around encryption and denial of service and, you know, particularly generative AI, right? And the blessing and the curse that it will be.
The first thing I'll say is that if you read all the reports that come out to consolidate incidents, and I'm sure if you asked Evan, the vast majority of these things aren't as a result of some hyper sophisticated threat actor. It's because a company's been had a blind spot. So Evan talked before about coverage of controls, so that they thought that they had a control in place, but it didn't cover everything. Or to what Caroline was talking about, systems were old and unpatched. It's really basic hygiene that leads to most of the incidents that occur. But as an industry, we do love a bit of Nostradamus action. We like to think about what's coming. Everyone talks a lot about AI and quantum computing are probably the two big ones that you hear about. Quantum computing, I don't know, everything I read about quantum computing says if it happens, it'll be in one degree a nightmare, because things that have been encrypted in the past will be very easily decryptable. As the future goes and as communications go, well, as soon as you've got quantum computers to decrypt, you also have quantum computers to encrypt. So the arms race has just moved up another level. AI, interesting to me, once somebody manages to exploit one of those potentially easy avenues of entry, if it's not so easy for them to get what they want, to find what they want, I think then AI and, you know, the deep fake stuff that you hear about will definitely have its place in allowing a very determined and I think often state-sponsored actor to be able to advance within the network. So it's certainly stuff that we think about, but day to day, I think at this point in time, it's still about getting the basics right. And it's making sure that you're not easy pickings, because as long as the pickings are as easy as they are, they don't need to go to all this new stuff. They can just leverage the exploitable stuff that they can already see.
How is AI helping identify the threats?
You're probably better placed to talk about that.
Sure. Maybe just to back up Jason's point a little first, you know, the threat actors that are conducting ransomware, you know, they're really all about the easiest path to their payday. So if you have your defenses up, you know, they will just move on to the next target. They don't get any special prize for picking a hard target. They'll go for the softest target they can find. So it's about having your defenses in place, doing the basics, like, you know, testing your network as an attacker. Can I get in? Trying to emulating an attacker and testing, are there ways in? Now, when it comes to AI, look, I think we're starting to see the beginnings of AI making an entrance into the cyber market. You know, initially it's actually making life easier for the attackers before it's making life easier for the defenders. Because if, let's say, you're an attacker with English as a second language, you can use the natural language processing AI type, you know, Chat GPT and similar to craft phishing messages and make it easier to attack many targets on scale. And it's interesting, in Japan, for example, they had been a little bit protected because the attackers weren't going after the Japanese because they didn't speak the language. It was harder to send them a phishing email. I mean, ChatGPT's changed that. It's a lot easier to attack someone in a different language. On the defenders side, there's a lot of these alerts that I mentioned in the monitoring system, hundreds, thousands of these alerts to look at. AI is starting to make it easier for us to scale our monitoring systems and pass through all of this sea of alerts and look for, you know, the needle in the haystack and make that job a little bit easier. But I think the advantage is still with the attackers on that one. So back to Jason's point, just make sure you're not the easiest target, and I'll move on to the next one.
It's like running away from the bear. You just got to be faster than your friend.
That's right.
Yeah. Okay. Look, that's kind of the questions we've got for the session tonight. But happy to take questions from the audience or on the call. Wow. One last question I've got maybe for Jason is around awareness. Right, a lot of, 80-odd% of compromises come with a human element, phishing, compromised credentials, and so on. What's some of the things in terms of building awareness with staff and teams across the corporate?
I think it's really hard to make just regular people in any company, regular users, understand just how much they play a part in it. Often they can be the first line of defense. Sometimes they can be the last line of defense. And we spend a lot of time and effort and money, frankly, in building awareness campaigns. We're about to do a lot more. You want to try and make them fun. And most importantly, tie them back to people's personal cyber hygiene. So if as soon as you tie a message to how do you keep yourself and your family safe, and by the way, if you follow these processes, by extension, you're going to keep your company safe. People tend to pay a bit more attention, and it's intriguing to me when I have these sessions with staff and the like. How many people don't do the basic stuff that for me is just completely unfathomable not to do, like multi-factor authentication on my personal email, just those sorts of basics. So I think it's about making it real to people and about constantly reminding them.
All right, well, we'll leave it at that. Please thank the.
All right, thank you to all the speakers tonight, and especially the panels. They were excellent. I'm sure you will agree that their insights have been invaluable. It's really evenings like this that Perpetual really likes to bring the insights to our clients, and this is aligned with our vision of being the most trusted partner to the banking and financial services sector. Our mission is to simply enable our clients' success and to make the market, our clients and ourselves, more efficient, effective, and economical, whilst managing cyber risk and maintaining compliance. Thank you very much. Over the past 7 years, we have invested significantly to deliver on the vision that the industry has really set for the digitalization and digitally enabled securitization, banking and finance industry. And, we have developed digital solutions for the treasury and finance teams right across the spectrum of stakeholders, from the clients through the law firms, the intermediaries, through to the underlying investors. And if you'd like to hear a bit more about any of those products, please speak to Matt Neese and to Hugh Moorcroft out in the lounge tonight. We're happy to talk to you. But two little pieces of housekeeping. We will send you a feedback form. Please complete it and let us know your feedback on tonight's event. And the whole loan sale report will be emailed to you. So thank you very much for attending tonight. Hope you found it enjoyable. Thanks for those who joined us online. And for those in the room, let's get out there and enjoy some drinks. Thank you very much. All right.